Welcome all to FSA Learning Module 10, the EOC on financial reporting quality. Now, this is mostly definitional. I think you'd be able to blast through these pretty quickly. So if you haven't tried them yet, my advice would be just to go and have a go and see how quickly you can bomb through them. But if you have, and you're looking for a walkthrough, then here it is, but it's not going to take us too long. First up, in contrast to earnings quality, financial reporting quality most likely pertains to sustainable earnings. Would you believe that's earnings quality? Relevant information? Yep, that's financial reporting quality. Adequate return on investment? That's earnings quality. This is testing your knowledge that earnings quality is all about whether your earnings are sustainable and whether they are enough. That is completely separate from financial reporting quality, which is all about the quality of information that you give. So is it decision useful? Is it relevant? And so on. If you don't give quality information, you can make no conclusion about earnings quality. So 1 is B. 2, information provided by a low quality financial report will most likely decrease company value, indicate that earnings are not sustainable. If it's low quality, as we just said, you can't really decide anything. It will certainly impede the assessment of earnings quality, as we said. You just can't make a decision. So whether it decreases company value or not, you could make an argument for that. If people realize there is, let's say, fictitious transactions, or there are fictitious transactions in there, but absolutely impedes the assessment of earnings quality. That's really the definition of low quality financial reporting. Next up, to properly assess a company's past performance, an analyst requires high earnings quality. Well, no, you can assess their past performance, and that past performance might turn out to be low earnings quality. B, high financial reporting quality. That's what you need to make assessments of earnings quality. You do not need both, because you don't need high earnings quality. You could have an absolutely superbly presented set of accounts that tell you the earnings are awful. Answer is B. Low earnings, or rather low quality earnings, most likely reflect low quality financial reporting. No, not necessarily. You could have amazing high quality reports and low quality earnings. Company activities which are unsustainable, yep, that would lead to low quality earnings, because remember, low quality earnings means not sustainable or not high enough. Information that does not faithfully represent company activities. Again, that's to do with low quality financial reporting, not earnings. So the answer is B. Next up, earnings that result from non-recurring activities most likely include, or rather indicate, I should say, lower quality earnings, yep. Because we want sustainable. Sustainable earnings are quality. Non-recurring is not sustainable, it's not quality. Biased accounting choices. No evidence that it's biased just because it's non-recurring. And lower quality financial reporting, no. May have been disclosed perfectly, but it's just not going to recur. Answer is A. Which attributes of financial reports would most likely be evaluated as optimal in the financial reporting spectrum? Conservative accounting choices? If it's conservative, it's biased. Bias one way or the other, conservative or aggressive, we want neutral. Sustainable and adequate returns, that is your definition of earnings quality. We'd want that to be at the top end of the spectrum. Emphasized pro forma earnings, no. Pro forma on non-GAAP. Certainly not that. Answer is B. Financial reports of the lowest level of quality reflect fictitious events, fraud. Bias is not great. Non-compliance is even worse. Fraud is the bottom of the barrel, making stuff up. When earnings are increased by deferring R&D investments until the next reporting period. So we're trying to increase earnings this year, but we're not doing it by manipulating accounting policies here. We are literally deferring spending cash, an actual action in the real world. So this choice is considered non-compliant accounting? No. As I say, we haven't violated any accounting rules. We've just decided not to spend money. Earnings management as a result of a real action. Yes, they are trying to manage earnings by not spending cash. Earnings management as a result of an accounting choice? No. It's nothing to do with accounting. It's a real action. A high-quality financial report may reflect earnings smoothing. No, that's not high quality. Earnings smoothing is when you're taking earnings from last year, holding them back and dropping them into this year, or pulling earnings from next year into this. Low earnings quality. Okay. Or C, understatement of asset impairment. No, why would you say it was quality if you were understating things? So both of these, earnings smoothing and understating, they reflect poor financial reporting quality. Not following the rules, not following the rules. Low earnings quality. Every chance that a high quality financial report shows low earnings quality. A perfect set of accounts presentation wise, just so happens that the company isn't earning enough. It is B. If a particular accounting choice is considered aggressive, so what does aggressive stuff do? Aggressive recognizes revenue early. Aggressive would delay expenses. What aggressive policies try and do is improve your position or your performance. Then the financial performance for the reporting period would most likely be not neutral from what we just said, exhibit an upward bias. That's the whole idea, not downward. Conservative accounting choices will most likely lead to, if we are being conservative, we will be delaying revenue. We will be speeding up the recognition of expenses. Couldn't think of what the word I'm looking for there instead of speeding up, but you get the idea. Delay revenue, bringing expenses in as quickly as possible. It will bias downwards your position and performance. What will it most likely lead to? Decreased reporting earnings in later periods? No, it's likely to lead to decreased earnings now. What might that do? If you're being conservative now, then next year you might be able to save some of those earnings and release them here. So probably increased reporting earnings in later periods. Increased reporting earnings period in the period under review? No, we just said decreased, so it's not A or B. Increased debt reported on the balance sheet at the end of the current period? Yes. A conservative approach makes your current performance, your current position look worse. Increased debt in the current period would make your position look worse. So it is going to be C. Which of the following is most likely to be considered a potential benefit of accounting conservatism? We wouldn't say it was financial reporting quality because we'd like it to be neutral, but there is generally a bias towards conservatism, even in financial standards writers. Why? One of the reasons quoted, a reduction in litigation costs. You're unlikely to get into legal trouble for understating profits. You probably would for overstating. So best to err on the side of caution. It's that kind of view. Less biased financial reporting? No. Less bias would be neutral. An increase in current period reported performance? No. Conservatism leads to a decrease. Answer is A. Which of the following statements most likely describes a situation that would motivate a manager to issue low-quality financial reports? The manager has increased the market share of products significantly. Well, if that's the case, I'd want to shout about it and make sure everybody could interpret that. Earned compensation that is linked to stock price performance. That's a motivation if things aren't going well. C, brought the company's profitability to a level higher than competitors. Again, that's something I'd want to shout about. I think the only possible motivation in there is my stock price linked compensation. that might motivate me to start lying to get more compensation. Not me, a person. Obviously not me. Which of the following concerns would most likely motivate a manager, more motivation, to make conservative accounting choices? Attention to future career opportunities. Well, if that was the motivation, you'd want to make your accounts look better. Conservative makes them look worse. And I don't think A. B, debt covenant violation risk in the current period. Again, I think for both of these, if anything, you'd be aggressive. C, unexpected strength in the business environment. Yes, it's this idea. Let's just hold things back at the moment and release them in the next period. We've effectively made too much profit here. People are going to get too excited. Let's hold some back and drop it into next year. C. Which of the following conditions best explains why a company's manager would obtain legal, accounting, and board level approval prior to issuing low-quality financial reports? Their motivation, that's not going to motivate them. It's not the opportunity. That's rationalization. Everybody else said, yeah, go on, do it. It's okay. I'm rationalizing why I did it. A company is experiencing a period of strong financial performance. To increase the likelihood of exceeding analysts' earnings forecasts in the next reporting period, the company would most likely undertake accounting choices for the period under review that inflate reported revenue. We are being strong at the moment, a strong period of performance, no need to inflate revenue. Delay expense recognition. Same argument. If you delay expense recognition, once again, you're making this year look even better and next year worse. Accelerate expense recognition. Yes. So bring expenses this year instead of next year. Dump them into here, accelerate them so next year's earnings look better. Which of the following situations represents a motivation rather than an opportunity to issue low-quality financial reports? Poor internal controls. Poor internal controls allows you to issue low-quality financial reports because there are no mechanisms that stop you. That is therefore an opportunity. Search for a personal bonus. That would motivate me. Inattentive board of directors, again, gives you the opportunity. B is the motivation. Which of the following situations will most likely motivate managers to inflate reported earnings? Possibility of a bond covenant violation. Yep, you don't want to do that. Typically, you'll violate the covenant if your performance is not good enough, so let's inflate it. Earnings have exceeded analyst forecasts. No. Why would you inflate earnings even more if you've already exceeded forecasts? You're more likely there to try and bring earnings down, to be conservative, to hold some back for next year. Earnings that have grown from the prior period. No, again, if you've got growth, you're good. Answer is A. Which technique most likely increases the cash flow provided by operations? So we're looking to boost CFO. Difficult to try and manipulate cash flow in total, but you can certainly do it between categories. A, stretching the accounts payable credit period. That would do it. Accounts payable are part of CFO. If you stretch the amount of time it takes to pay your suppliers, to pay your vendors, you're effectively getting them to finance you. You know this from the world of indirect cash flow preparation. The increase in accounts payable gets added back. So stretch your payables, that will help CFO for sure. B, applying all non-cash discount amortization against interest capitalized. No, you'd want to apply all non-cash discount amortization against interest expensed. So B isn't going to work. Tricky one that. Let's just see what they're talking about. Making up numbers, imagine you had interest expense of 12,000. What they're saying here is some of that was cash. So imagine it's a bond, for example, and you paid coupons of 10,000, but you issued the bond at a discount. So the rest of that interest expense is amortization of the discount, not cash. Now, some of that's been capitalized. So let's say, give myself some room. Let's say here we capitalized 40% of that interest. That would be 12,000 times 40%. 4,800. And we expensed the rest. We expensed 60%. So 7,200. There's your 12,000. Now, how would you spread those logically? It makes sense if I've capitalized 40% to say, look, that was 40% of the cash I spent, 4,000, and that was 60% of the cash I spent, 6,000. So we spread the 10,000 that way. That's the cash. And we do the same for the amortization. 40% of the amortization goes to the capitalized portion. So amortization was 2,000. 40% of that is the 800. And 60%, 1,200, goes to expense. That's purely logical if you are not trying to manipulate your accounts. However, what you could do is this. We capitalize 40%, 4,800, expense 60%, 7,200, there's my 12,000. But I allocate all of the amortization to the expense. I say, look, that expensed amount included all the amortization, non-capitalized. There's my 2,000. What that means is that 4,800 of cash would be capitalized and only 5,200 of cash would be expensed. What's the impact? Up here, logically, we treated it here and we got CFO as an outflow of 6,000. Down here, CFO as an outflow would be only 5,200. So what you'd want to do if you were manipulating was allocate all of that non-cash amortization to expenses, not to capitalized. C, shifting classification of interest paid from financing to operating. No, that would bring down operating. That makes no sense. So 23 is A. Next up, bias in revenue recognition would least likely be suspected. If the firm engages in barter transactions, that's very tricky. I would be concerned about bias if there were barter transactions. It's very difficult to value. B, reported revenue is higher than the previous quarter. Well, you would hope that was the case for a growing company. That doesn't make me too suspicious. Revenue is recognized before goods are shipped to customers. That makes it easier to manipulate. So C is a warning sign. Going to go for B. Which of the following is an indication that a company may be recognizing revenue prematurely relative to its competitors? Well, if they're recognizing revenue prematurely, you would expect my days of sales outstanding to increase. It's going to take customers longer to pay because you're putting the revenue in before you've even sold it. So days of sales outstanding should increase as they take longer to pay, which means your receivables turnover should decrease. So what do we have here? Asset turnover decreasing. Well, that's got total assets in there, so that's got all sorts of other things, so I wouldn't look to that to make a decision. Receivables turnover is increasing. No. Days of sales outstanding is increasing. Yep, absolutely. They would take longer to pay. Which of the following would most likely signal that a company may be using aggressive accrual accounting policies to shift current expenses to later periods? Over the last 5-year period, the ratio of cash flow to net income has increased, decreased, or fluctuated. Well, I would expect it to fluctuate because accruals accounting doesn't always match with cash flows. But in the long run, this should be somewhere near 1. Accruals accounting should just reflect timing. If you have a trend, then something's going on. And if we were currently shifting current expenses to later periods using accrual accounting, what we're going to do is boost net income in the near term. And if you keep doing that and keep doing that, net income relative to cash flow is going to be higher. And if that denominator is higher, you are bringing this ratio down. It is a sign of low quality if that ratio consistently decreases. An analyst reviewing a firm with a large reported restructuring charge to earnings should A, view expenses reported in prior years as overstated. Well, they hadn't done the restructuring yet, so we can't say they overstated anything. Disregard it because it is solely related to past events. It happened, you can't just disregard it, so I'm hoping for C. Consider making pro forma adjustments to prior year's earnings. Yes, I would consider doing that. We have a large restructuring charge, which is going to distort our trend analysis. We want to look at the last 5, 6, 7 years, however long we decide on. I would typically look at the last 5 years of returns to try and get a nice trend. Well, if there was no charge for all 5 years and suddenly this year we have one big charge, it's going to be difficult to see that trend. So I'll put pro forma earnings together and spread that charge over the last 5 years. That'll give me a better view of what the trend actually was.